Hi everyone again, and I'm back. We're gonna do an ROIC problem. This example would be a bit more representative of what real life analysis would be, because we're actually gonna use Disney's actual 10K statements. As you can see on the left, we have the statements of income, or income statement, and consolidated balance sheets, and we're going to use these to calculate our NOPLAT and invested capital. All right, let's start with reading the question. ROIC problem. Provided are the 2019 financial statements for global entertainment giant the Walt Disney Company. Disney operates TV networks, movie studios, theme parks, cruise lines, resorts, and retail stores. Disney uses operating lease contracts for broadcasting programming rights, cruise ships, and retail outlets with the present value of 69 uh, billion in 2019 and 55 billion in 2018. Disney also reported capital lease obligation with a present value of 449 million in 2019 for 540 in 2018. Assume other current and non-current assets and liabilities are operating unless information suggests otherwise. So you see the PV of operating leases right here, like it described right on the statement. You have your marginal tax rate of 22%, your normal cash for the hotel industry, and your cost of debt, cost of equity, and WACC. We're going to calculate the normal cash later on, provided that you have a percentage of sales and actual cash. Compute March. That should be Disney's 2018 or 2019's RYC. Did the firm add value to shareholders in 2018? Why or why not? This question relates to when you compare the ROIC, return on invested capital, to your WACC. Because this is your cost, this is what you make money for, right? So you want to compare this ROIC and the WACC, whether they um, made a positive uh, return after cost. All right, we'll start with NOPLAT, and we remember, if I want to track this again, let's find the NOPLAT formula. Your NOPLAT is equal to EBITDA minus adjusted taxes plus deferred taxes. So we'll start with EBITDA. So EBITDA, and you always start with total revenues. And first of all, we only have 2 years, right? And we're trying to get the ROIC for 2019, fiscal year 2019. But what we need for the numerator, we need 2019 NOPLAT, right? But for the denominator, we need 2018 IC. So let's just keep it in mind. So for the NOPLAT, we're just going to use the 2019. So for the 2019 numbers, we have this 69. Just going to type it 69,570. And I'll try to put a comma. Looks better. All right. Well, you have your costs, and I'm just gonna read through. Everything looks like everything is operating, so I'm just gonna take the total costs. Um, so it's easier. Technically, you take all of them. Well, let's just take all of them uh, for reference. Cost of services, costs of products, SG&A, DA, and then we'll try it here. Too hard, right? Because we can just copy paste. And remember, when we calculated EBITDA, you have the implied interest on operating leases. So, what is our operating leases? So we use the before number, right? Because you need the previous number to get the interest expense times the cost of debt. Since the cost of operating leases is not provided, we're just going to use the cost of debt. So interest on operating leases. Uh, so cost of debt times your previous number. So we have 2700, and we're adding it because it lowers down our um, again, we're adding this because we're lowering down um, our EBITDA. Let me think for a second. Because before we had just the rent expense, right? And now we have interest expense and depreciation. Um, this is assuming 2019 that it was recorded as rent expense, and it might be somewhere embedded right here or right here. The depreciation cost is already right here, so we don't have to worry about it. But interest, we're not in the business in making interest, so we add it back. So because it lowers down our EBITDA, so we add it back. Because it's embedded here, we add it back. So it's basically taking the effect of the interest on operating leases. So take the sum, and we get 14,000. So that's our EBITDA or EBIT, right? Let's just call it EBIT. Operating EBIT. How about that? Well, the next part is adjusted taxes. So, adjusted taxes. Where do we start with adjusted taxes? Well, your taxes on the income statement. All right, how much do we pay? So, what did we pay? Okay, 3,000. Remember, we're gonna subtract it later on. For now, it's positive because we're gonna subtract it later on. And notice that if it's an expense, stay at positive. If it's a benefit, then stay negative. Um, all right. So now what we're gonna do is add the stuff that we did not include in calculating EBIT or EBITDA. Well, the first thing I always do is take care of the interest. So I'm just gonna put uh, tax on. Yeah, let's just put tax on operating leases. operating lease interest, not operating leases. So this times you always use the marginal tax rate, which is 22%. So let me just grab that number, F4 it, so we remember that this was the marginal tax rate. See. And then we multiply the interest, right? Next one is next one on the line that we did not include is restructuring, right? Because and it's an expense, so should be a tax shield or a TS in short on restructuring. Restructuring. So use the same marginal tax rate. You just change this to times 1183. Now it's a tax shield. And remember, if it's a tax shield, then positive. If it's a tax, then negative. Why this is a positive? Because we're just trying to take the effect of lease interest on the taxes. So this is a special one. But when it's an expense, then it would be a positive, right? So it lowers the EBT and lower taxes, so you want to adjust it higher. If it's an income, it, it higher makes the EBT higher, therefore your taxes higher, so you want to take minus it from the taxes. Um, so the next one is other income, net gains from Hulu acquisition. So sounds like a one-time charge. So and it's positive, so it should be a tax on other income. And 43757. All right. Next one would be interest expense, and it's negative, so it would be a tax shield on interest expense times 9. Oops, I forgot the sign right here. Again, if it's a tax, then negative, and if it's a tax shield, it's positive, except for the operating lease interest. All right, equity in income, investees, um, and it's a negative, so it's a tax shield on. Let's just say equity income. So it's 103. All right, and then I think that's it. Income from continuing before taxes. So that's EBT. So we're done. Um, Total adjusted taxes. I want to underline this thing. So we have 3181. Remember that we decrease this later on. Well, next thing is change in deferred tax liabilities. Net, I should say change in net deferred net deferred. Probably wrong spelling, right? Deferred. And I just want to show it on the slide. It's right there. So let's take a look at the balance sheet, whether it exists or not. So I don't see it on the assets part. but it might be somewhere over here. Liabilities, compression, borrowing, deferred revenue, deferred income taxes, right there. All right, so it seems like it's now in the current portion. It's all in the long-term portion. Sometimes it's somewhere over here, maybe, or maybe it's somewhere over here. So you want to take a look deeper and try to incorporate it. Maybe it's somewhere over here too. So, but for now, for this example, I'm just gonna incorporate this. So let's start with 2019, right? 2019 deferred tax liability, and then 2018 deferred tax liability. Um, and have this, and I'm gonna minus this. So what is it? Big. This minus this. Boom. Change in that deferred tax liability, right? So now we have the three parts. All we need to do is to sum it all. So NOPLAT is equal to this EBITDA minus adjusted taxes plus change in deferred tax liability. And we have 16 billion. Well, let's calculate the invested capital. So perhaps we should move it right here. Would that help? Maybe. Uh, well, let's start with invested capital. Well, quick look on how we did it on a PowerPoint. Where did we start? Right there. So we'll start with operating working capital, and then we'll go through the hard assets. All right. So and keep note that we're using 2018 because that will be our denominator, right? To get the ROIC, you need the what you earned that year divided by your invested capital the year before. Well, the first thing that we usually get is the normal cash, right? And we have it right here that the normal cash is 4% of sales. So, and keep note that it's 2018. So, let's just say 4% times total revenues for 2018 is 59,434. Multiply that, then you get the number. I'll make sure these are all have that format. Okay. 4% of the 2018 total revenues. Okay, good. What's next? Let's go back to the balance sheet. So cash, we took the normal cash already. So receivables. So let's start with receivables. Is that part of the business? Of course. Inventories, is that part of the business? Of course. And then we're just gonna take the 2018 numbers. What's next? Television costs and advantage. Okay. And then this. Well, other current assets. We said assume other current and non-current assets are operating unless information suggests otherwise. So we're gonna assume that the other current assets is operating. Yep. And now, once we're done with the current assets, we'll take a look at the current liabilities. Accounts payable, of course, you need that for your business. Current portion of borrowings, no, because that's debt, that's interest bearing. Deferred revenue, yes, because that's what you need to provide services. All right, so we have all these operating cash flow numbers. All we need to do, oops, press something, Control U, and we just need to sum it up, and we have 982, and this is net operating working capital. Well, how about the hard assets? Well, let's take a look. Hard assets, film, television, cost, yes, of course. Investments, do we include it? Let me grab the number first. No, because that's interest bearing, right? You make money out of it as interest. Parking, that's what we're in a business in, and it's let me see, it's right here. Net of accumulated depreciation includes land and current projects in progress. Intangible assets, of course. You need Disney name, right? To have the Disney show or your Fox or your Hulu. Copyright and internet website. Goodwill. Do we include goodwill? No. And there's actually a huge increase in goodwill. Look at that when they acquired the Hulu. So be careful not including the goodwill. And then other assets. Back on the assumptions earlier, you need assume that the other assets are operating. So we include that. And then one more thing before we forget. Uh, you want to include the ROU assets, but they're not here. So we're just gonna assume a PV of operating leases, which is right there. Boom. All right, so we have everything. Well, we'll check the liabilities, I guess. So borrowings, no, they're it's interest bearing. Deferred income taxes, that's what we used for the NOPLAT calculation. Pension and retirement health, no, that's below underlying adjustment commitments and contingencies. It's actually empty. So no. So there's no other long-term liability stuff, only asset. So what we need to do is add them all. Uh, and that would be our invested capital. Right? So the difference between the quick and dirty way of doing things, you might not include film and television costs because you're only including this, right? You might not include all these other stuff. So it's more comprehensive than the quick and dirty way formula. And of that, now we have invested capital. Let me just put a box on it, and we have our no plan. So now we can calculate our ROIC, return on invested capital. Remember that the formula is what you earned this year divided by what you started with. So NOPLAT divided by invested capital. And 15.6%. Well, what is our WACC? 7%, right? Meaning the spread is positive. So the spread is positive since ROIC is greater than WACC and the spread is positive. Um, Therefore, the firm generated positive economic profit and created shareholder value in the fiscal year 2019. This is how much our capital costs. This is how much we return. And we actually almost doubled it, or more than doubled it. And so we created value. Um, that's it. And you can actually put the numbers. I should have done that. Invested capital would be this ROIC, and then my little essay. Not really an essay, it's just a sentence. Um, there we go. Hopefully that helps. And we actually used Disney's balance sheet and income statement. So, it doesn't necessarily is hard. It's actually really nice to learn how to do this. We learned that if you make more money, more return than your cost of capital, you create economic profit. And therefore, Disney, with their assumptions, actually almost doubled or more than doubled the costs. All right, hopefully that helps. I will post these files below on the link, and hopefully that helps you um, learn how to calculate um, evaluation, evaluation technicals. All right, and I'll try to post more videos on how I actually value companies. Um, Hopefully, you learn a lot, and spent my whole day on this. So, um, peace.